You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Santa Barbara, California, from the Twilight Zone. You're nuts. That's what I would tell you if anyone a year ago had suggested to me that we would be facing a global pandemic that would put us in a recession magnitudes greater than 2008. Of course, I'm basing that on GDP numbers. A pandemic that would make all bars and restaurants shut down, cancel the NBA, make Major League Baseball play without fans, and put, God forbid, the NFL itself in question, right? I mean, there's like players opting out. By the way, that makes a lot of sense to me because a lot of those guys have these huge body mass indexes, and if they get COVID, man, some of those guys are toast. So I get it. But you know what? I would also think you were nuts if you told me that despite all of what we've seen, all of this financial destruction, that our apartment portfolio would still be performing, well, at pre-COVID levels, actually even better. If you talk about what's going on in our portfolio at our Wealth Formula Accredited Investor Club. By the way, you can sign up for that by going to wealthformula.com. And so this idea that all of this crazy stuff could be happening, yet our portfolio would be doing great. Well, let me tell you something. It's like we're living in the Twilight Zone right now, right? It's totally the Twilight Zone. And in this scenario, I would love to say that I predicted this and I, curated this portfolio because I knew what was going to happen. But here's the thing. What I thought was going to happen was we were going to have some sort of correction, and I so felt like working class apartments would be the right place to be in. So that's why we didn't go, moving around into all these like bright and shiny things, because we just felt like, let's just let this thing play out. The risk-adjusted growth or profits on these things was not worth the risk. And you know what? Sometimes it's just better to be lucky than good. I mean, I'd like to think I'm good too, but the luck here is fantastic. So what happens, in the next 6 months? That's the question. What happens in a year? What happens in 2 years? Yogi Berra, the one of the smartest prophets of our time, said that it's tough to make predictions, especially about the future. That is a wise man. So no matter what anyone says right now, here's the thing: is we're probably throwing darts, and we're gonna go back, and somebody's gonna say, "Oh, I told you I was right." Look at Peter Schiff right now. I mean, Peter's a smart guy, but it's almost like he's acting like he predicted a pandemic or something. He's doing this victory dance. But anyway, that said, let me make a couple of observations first. And I'm going to focus on apartment buildings because that's what we do for the most part in Accredited Investor Club. We do some, we have a big portfolio of that, some self-storage as well. But apartment buildings right now are still doing very well, at least the working class stuff that we do in great, in these big growth markets like Dallas, Fort Worth, and Phoenix, Scottsdale. And here's some perspective for you. Interest rates, the Fed has said this, the interest rates will artificially be low for years to come. And you know what else? There's a ton of money on the sidelines that has to be deployed. And I'm not talking about individuals. I'm talking about, pension funds. I'm talking about, these big family offices with mandates to deploy capital. I mean, there's a need to actually place this capital, right? So what if, now if you've been listening to me, the last several weeks, several months, that I have been thinking, we're probably going to have this tsunami of defaults and then have this, massive opportunity to buy. Well, we're not seeing it. Guess what? We're not seeing it at all. We're not seeing much deals because yeah, there's no distress. If there's no distress, there's no deals. Nobody wants to sell something they're making money with. So what if instead of that tsunami, we go straight from, stable or maybe a little bit of decreased rent growth in the next 6 months or so. Next thing you know, there's a vaccine, and then there's massive demand. There's low interest rates. The banks have no problem lending again. Big money's coming off, and they're saying, hey, that multifamily sure did perform well throughout this area. And if we have a mandate to invest in real estate, a certain part of our portfolio, maybe we should be looking at residential stuff. And then before you know it, we've got cap rate compression a year from now. What if that happens? Now, honestly, I'm telling you that if you listened to my show a couple of months back, if I had said this, well, I wouldn't have had a straight face. I wouldn't have been able to say that with a straight face a couple of months ago. But now I can actually see that happening. Not for sure. I'm saying I could see it happening and not be surprised by it. Anyway, in the interest of continuously trying to understand the future of real estate investing and knowing what we're doing, I am interviewing yet another economic real estate sage this week. He's a guy who specializes in apartments. He actually spoke at our last Wealth Formula event, which now seems eons ago, right? I mean, that's crazy. It just seems like forever ago. His name's Ryan Davis. He's a very smart guy. He's a guy we listen to as we take advice on apartments as part of his consulting business. Anyway, make sure to listen close to this interview with Ryan when we come back. Welcome back to the show, everyone. Today, my guest on Wealth Formula podcast. He's been on the show before. He's economist Ryan Davis. He actually joined us at one of our last Wealth Formula meetups. Of course, the last one we had was canceled, but Ryan was at the one before that. He serves as a chief operating officer at Witten Advisors and provides fact-based research, analysis, and discussion to help clients like us formulate their apartment strategies. And these insights inform investment decisions for multifamily development and buy-sell opportunities, which, as you can imagine, we're all looking for some of this advice these days. Ryan has a PhD in economics from the University of Texas. Ryan, welcome back to Wealth Formula Podcast.
Thank you. Glad to be back.
Yeah. It's been it's like a pandemic ago we last talked, right?
Right.
Listen, I want to kind of jump into the whole what the heck is going on. I mean, the overall.
Sure.
If you would. Kind of give me your overall assessment of the economy. I mean, obviously, we know these huge drops in GDP, et cetera, which were expected last quarter. How is this all affecting real estate asset prices, especially, as apartments, which is our interest and something that you specialize in?
Mm-hmm. Sure. So yeah, that's the great unknown is the pace of the recovery. So we had that big drop through April in terms of employment, and then we got a bounce back in May and June, and the hope was that it was going to be a V-shaped recovery. But then we saw virus cases ramp back up in the second half of June into the early part of July. Local economies started rolling back some of their openings. And so with that, we've kind of stalled out recently. So we'll get the July numbers this Friday for overall payroll gains. And I think the consensus is anywhere between 1.5 million jobs. It could be negative. So who knows? But it looks like the hope for a V-shaped recovery in the economy has kind of stalled out after the first 2 months of optimism. And so we think that going forward, we won't see the worst is behind us, really. And so we won't see, the big losses that we experienced in March and really into April. So kind of what we're calling for right now is for the national economy to continue to add jobs for the remainder of the year. And then beginning next year, a recovery should emerge, and that would sustain demand for housing and ultimately apartments going forward. In the near term, as far as multifamily goes, we expect some pain through the end of this year and then into the early part of next year. In terms of pricing power, if we had to boil it down to one number, it's rent growth. So year over year effective rent growth, we think that declines to 8% rent cuts this year and into early part of 2021. That varies considerably on a local market basis. I think our worst performing market is Metro New York City, probably no surprise there. But then also many of the other gateway markets such as Boston, LA, the Bay Area, et cetera, we expect rent declines to be lower than that 8% across the board. However, many of the inner West, Texas, Southeastern markets should outperform, still see rent declines, but not closer to the 5-6% range at the depth. And so we expect near-term pain, but then as we get out into 2021 and afterward, and the economy begins to add a lot of jobs, we would expect rent growth to return to multifamily. And then what that means for pricing in terms of apartment assets. For right now, in the second quarter, hardly any deals traded hands. So it's really tough to get a sense of where pricing is. And with the deals that have traded, though, the cap rates have remained relatively stable, which is a good sign. We've heard from some of our merchant builder clients where they had assets they had constructed and were going out to the market to sell. In the early part of April, they were saying 10% discounts in terms of compared to pre-corona levels. But that has since come back in the last 45, 60 days, and maybe it's only 1% to 2% in terms of the haircut that they're seeing out there right now. There's just a ton of capital that wants to get back into multifamily. At the same time, there's hardly any distress out there right now. So there's a lack of available to supply to buy. And so everyone is just kind of in this standstill. There's a big bid-ask gap because buyers aren't willing to pay yesterday's prices for assets, but sellers aren't willing to give any deep discounts right now. And so it's kind of at a standstill and see how all this plays out.
Yeah, it's really interesting. We're obviously, through, you work with Western Wealth Capital is one of my partners, and it's funny because we were kind of thinking, well, maybe there'll be some real buying opportunities, but we've seen a little bit, maybe just from buyers or sellers who just are wanting to get out while they're ahead. Maybe they made some money, maybe they and at this point they're just thinking let's just cash out, and maybe they're willing to take a little bit less. But for the most part, if you look across our own portfolio, and it might be because it's largely, again, Texas and Arizona, et cetera, that, and maybe it's because it's mostly working class B and, high C class apartment, but our portfolio, the numbers are just as good as they've ever been in terms of, occupancy, in terms of even our, we're still raising rents, and so so when you look at that, you're like, well, I mean, how do you expect there to be any, smoking deals out there? If the sellers really aren't feeling any distress. So is there a difference, when you look at something like a B and C class apartment scenario versus A right now, or have you been able to break that down a little bit? Because I think the people I know who are in the A class and new build are, they're certainly feeling things a little bit more than we are.
Yeah. So what we've heard from some of our clients in terms of early on, so May, June, in terms of rent collections, Class A's were actually, from a nationwide perspective, actually exceeded the Class B and C product. Now, we don't think that will continue going forward. And the main reason is that new deliveries that are coming online that they will compete with the existing top of the market product. And so we think that it will be short-lived in terms of the top of the market outperformance. And another part is due to just the nature of this downturn, where low wage sectors were hit extremely hard in April. Got some bounce back in May and June, but the leisure and hospitality sectors, lower paying positions, those have been the most impacted so far. But going forward, we don't think that this downturn would be any different than prior recessions in terms of the Class A leading the way down in terms of occupancy, drops in occupancy, and also rent growth or rent cuts in the near term. So Class A's will lead the market down, but then as we get out into the later part of next year and into early 2022, then Class A's would outperform the broader market. So yeah, we think through the end of this year until early next that B's and C's will hold up relatively better. But that's mainly a function of just the competition that it takes to get these new projects that are in lease up. They will get leased up. It's just a matter of the market clearing price. And so those have to compete. Those compete mostly with the top end of the spectrum. And so we see big rent declines and concessions in the Class A space going forward.
You know, there's this thesis that's going around in the multifamily space, and I've been sort of looking at it this way too for a while, though I'm starting to feel like it's maybe not going to happen. Is this idea that there's going to be a potentially, before we really rebound and start heading up again, that there'll potentially be a big tsunami of defaults and things like that. Right now, at least what I'm seeing and hearing about in terms of the lending markets and in terms of these properties, there really isn't much indication of that right now. Is there? I mean, what do you think?
No, at least not in the short term. And again, it goes back to my earlier comment. There's been no distress really. And so that is due mainly to the huge stimulus packages that have been passed, both from a fiscal standpoint and a monetary standpoint, which is, it's crazy to think that GDP declined at an annualized rate by 32%. However, incomes soared. And so that's all due to the stimulus that we saw. And so that's helped prop up renters' incomes and allow them to pay rent. Now, going forward, I think some of these, the number of defaults, I don't think there will be a tsunami, at least that's how we view it right now. Ask me again in a week and it could change. But I think that the defaults will be very market specific. And so those geographies that have been hit harder will see a larger number, but many of the Texas markets, Phoenix, Denver, Southeast, high growth markets where you got this short-term tailwind in terms of folks, at the margin more, the trends that have been in place for years of folks moving from gateway markets into the inner markets will be kind of given a steroid shot really in the near term. And so that would help to prop up multifamily fundamentals. And so if you're expecting a tsunami of defaults in any of those markets that I mentioned, and again, it kind of gets a little bit granular in terms of, potentially Orlando might have some problems just with the amount of supply, and then the low wage in tourism industries being impacted more dramatically, and that would lend to some weakness in Orlando. But outside of that, maybe Houston, you could argue somewhat, but outside of those two, in those areas of the Inner-West Texas, Southeast Florida should be hold up, relatively well. And I would think that the main stress points will be out on the coast in California, potentially Portland. We do think Seattle holds up relatively well, and then Northeast in terms of New York and Boston as well. So I think it's very locally market driven.
Yeah. It's interesting. We were a little worried about Houston too, but our Houston portfolio is actually doing awesome. It's not having any problems at all, which was again, we're knock on wood. That's what it's been so far. Let me ask you another question. You mentioned the pent up demand of money on the sidelines waiting to get back in, and in many situations they have to get back in, right? They're mandated to deploy capital and that sort of thing. The one thought that I've had through this is multifamily and multifamily in general has held up so well during this period of time. Does that potentially create a situation where the big money that's coming in starts looking at this even harder as potentially a little bit of a little bit of a hedge or a little bit of safe haven? What do you guys think is going to be the effect of that? The relative stable performance, and then ultimately, having all of this money on the sidelines. Do you see, paradoxical, even further compression of cap rates over the next couple of years? What's your thought on that?
Yeah, and so kind of pre-corona, our forecast was for cap rates to continue to decline. And taking a step back, it was as mainly driven by global factors with the aging populations across the globe that have built wealth up, and all of that investment needed to be placed somewhere. And so those trends were driving returns lower for longer. And so those are a demographic that have not been affected by the pandemic. And so just from a global standpoint, we're expecting returns across all assets, whether it's stocks, bonds, all classes of real estate, whether it's multi or industrial, retail, office, et cetera. Those returns would continue to head lower. And now we've had the pandemic, and we've seen multifamily and industrial hold up exceedingly well. And who knows what to make of retail, office, and lodging, just lots of pain in those sectors. And so if you need to be allocated to real estate, then multifamily and industrial are where you want to be, at least in the short term, and especially if you're looking for consistency of returns and risk adjusted basis. Multi and industrial have outperformed the other asset classes. And so really, to get into the lodging, office, retail space, probably more opportunistic mindset in terms of those assets may need to be repositioned, et cetera. And so I think a lot of that money that's out there is not looking to get, there's a lot that's looking for that type of asset turnaround story, but there's also a lot of money out there that needs the stability. And so that should continue to compress cap rates, or put a cap on the cap rates. And so it would be no surprise if cap rates on an aggregate basis hold steady and maybe even decline despite a deterioration in short-term fundamentals. And part of that is due to the long-term belief in apartments going forward. And so, yes, there's a short-term dislocation where we expect some move-outs this year. Actually, there are a lot of move-outs that we expect. And so there's going to be a lot of doubling up, folks moving back in with their families. But then there's going to be pin-up demand as the recovery takes hold next year, and that will be released. And so we see leasing to be through the roof next year, and then out into 2022. Then at the same time as that demand story improves, in the short term, we see starts decelerating dramatically. So we're going from a 400,000 unit run rate to about 200,000 units by the early part of next year. And so new production is going to get cut in half. Now that we don't get any benefit of that immediately. So we have to wait till the later part of 2022 and 2023 before we see that slowdown in production really lift fundamentals. And so I think everyone is seeing that, yes, there's some short-term disruption in the multifamily market right now, but the long-term drivers are there. And if you have the capital to wait out this very painful period in the short term, then there will be major benefits after that we should see after next year.
Now, one of the things you said, I think, earlier is that the worst is behind us. Do you believe that's the case in terms of rent growth and, rent cuts and that sort of thing right now?
I think the worst is behind us in terms of the economy. I think that going forward, we should continue to produce job gains on a monthly basis, though this next report could see some layoffs, but we'll see. The consensus is 1 million, 1.5. In terms of multifamily, we do not think the worst is behind us. We think that fundamentals will continue to deteriorate into the early part of next year. We think that, kind of right now, in terms of year-over-year rent growth, in the early part of this year, was, call it, 3.5%. We've since gone down to 0% in the second quarter. So on a quarterly basis, we've seen some dramatic rent cuts. Again, this is on a national basis. And then as we move forward, we see occupancy dropping by about 3 percentage points into the early part of next year, rent declines of about 8% through the remainder of this year into the first quarter of next year. And so, no, we do think that there will be some deterioration in fundamentals going forward. On the flip side of that might present some opportunities. And so any assets that were purchased, especially in your space, in terms of if they were bought at the top of the market at the end of last year into the early part of this year, and now that value add story isn't there where you might not be able to get the rent bumps that you were expecting. So some of those assets will have to be recapitalized. And so that might present some opportunity as the year progresses. But again, like you said, we haven't seen that materialize so far.
Yeah.
So
that's the tricky part, right? I mean, it's sort of like, I think when you're on the buy side here, you're saying, well, I mean, these prices that we're seeing right now, with prolonged, low interest rates, which we can pretty much guarantee at this point for a period of time. And then the pent-up demand, it's sort of like, okay, well, this actually might be one of the better times to buy if you consider what could potentially happen in the next, 18 to 24 months in terms of, explosive growth. When you look at those indicators that you're talking about that may lead to some of the more explosive growth metrics, what markets come to mind the most for you?
Yeah, so our general geographic areas that we like the Southeast, parts of Florida, Texas, and the inner West. We really like Atlanta. We like South Florida. There's a little more pain in the short term. Some of our clients are saying, in terms of rent collections, Northeast. But also, LA, but then South Florida is outperforming those two areas, but still lagging some of these other markets. So we like the Texas markets long term, inner West, Phoenix, Denver, Salt Lake as well. We like Seattle. That's an outlier on the West Coast, but then the other markets, whereas the Bay Area, we expect those rent growth numbers to average 4.5%, which stack up really well across the nation. But for those markets, that's a recession pretty much. And so compared to what's normal and the cap rates you have to pay, the rent growth numbers there are kind of lackluster. And so the Midwest the markets, they won't be hit as hard, but still they don't get that explosive growth going forward. And so we really like the the inner West Texas, southeast of Florida markets. And, part of that has been being driven by the migration flows. So domestic migration numbers have really helped out all of these markets. We've seen outflows from the Northeast, Boston, New York, the Bay Area, Southern California. We've seen migration outflows from those markets into the inner West, call it Las Vegas, the Inland Empire, Phoenix, Denver. People moving from the coast into those markets, and then also parts of Texas as well. But then in terms of the Northeast, the flows that are coming in to the Nashvilles, the Charlottes, Raleighs, Atlanta, Florida markets, and then also Texas as well. And so those trends have been accelerated, at least in the short term. But it's important to remember that those have been going on for a decade, at least, even more than other markets. And so it's not anything new, but at the margin that will support many of these other markets.
Yeah, on the West Coast, I mean, there's that flight to Arizona as well, right? From California, leaving California. One of the things that is worth talking about is what effect this has had, the pandemic and the recession on the lending market with Fannie and Freddie, and how that might be playing into any of the growth or lack of growth.
Yeah, I think on the financing side, debt for stabilized assets, it's there and it's cheap. You may have to have higher reserves than you've had typically, but for the most part, it's there. And so that's part of the appeal of buying assets right now with these record low interest rates. So I think for stabilized assets, it's there. For new construction, it is dried up considerably, and this is a change in the last 30 to 60 days. And so the Fed does a survey each quarter of banks and their tightening of multifamily construction lending standards. And the latest report shows 70% of banks tightened their multifamily construction loans last quarter, which we haven't seen those levels since 2008, 2009. Yeah. And so I think part of it's the lenders are trying to make sense of what they have in terms of all these other asset types in terms of real estate or retail, lodging, office loans. They're trying to spend a lot of time working those out. And so then you add on the uncertainty in terms of the economic recovery, et cetera. They've pretty much put a halt on new construction loans. And so that's been a big change here in the last two months, call it. And then on the equity side, I think returns have been increased, but still available and interested. But a lot of the equity, and especially focusing in on the new starts pipeline, if all the deals that had been started are continuing, and it's kind of a mixed bag from our clients in terms of are you seeing delays, or actually some of our clients reported they were able to speed up the timing in terms of getting able to get trucks into sites very easily, and then also the construction workers that were working on hotels, motels, those have come into the apartment sector, and so that's provided more manpower in terms of getting these deals done. And so those that were under construction are continuing to proceed. Those that were capitalized, I think, but haven't begun, they haven't pulled out completely. They just said, let's press pause to see, can we get any break in construction costs over the next several months? And so the equity and banks are still willing to do it, move forward on those deals that have been capitalized but are slow playing it. And so, and then you get to the others where there's land sites and they hadn't been entitled and hadn't been capitalized. Those deals we think have been shelved for right now. And so kind of where some opportunity could be is on the land side of potentially purchasing some land sites that might be teed up for development as we get further along in this recovery.
Again, one of the things that you're saying, though, in terms of construction loans not being there, again, it helps us, for those of us who have apartment portfolios already that are already there. That again goes to the issue of a simple supply and demand issue, which we can benefit from if there's not a whole lot of new builds. How, this is a major driving variable in apartment buildings nationally. Can you give us a little bit the idea of, just not being able to keep up with, population growth in various parts of the country? Can you give us a little bit of an, sort of a 1,000-foot view on how the perspective on how big of an issue that actually is?
I don't know if it's that big of an issue, on the whole. And I think that some of these higher growth markets, in terms of where we've call it the Atlantas and North Carolina markets, central North Florida, Texas, the inner West regions, where we've seen large population growth statistics, high growth markets, but they also tend to be the highest in terms of supply for housing. And so it's more easy to build in those markets, especially as you get away from the central cities, et cetera. And so where we've seen the biggest barriers to supply are out on the coast. And so we've seen job growth be pretty good in those markets, but the supply hasn't kept up at all. And so that's why you're seeing these big rent affordability problems in the coastal markets. And so we think that supply not keeping up with the population dynamics is more of a coastal problem. But then, as you get into the markets that are more accepting of new development, then we've seen housing supply increase at a rapid clip in many of these other markets. I think Austin, even through the June of this year, permit activity for multifamily continued to reach big levels. And so I think year to date in Austin, it's already pulled permits on almost 10,000 units already, which is huge numbers. And so I do think that while these population growth numbers in some of these markets are off the charts, especially compared to some of the coastal markets, that supply has been able to keep up there. And so you see pockets of where rent growth bumps up to 5-6% levels. That's especially was the case in Phoenix and Las Vegas over the past 2 to 3 years, where those markets were leading in terms of rent increases. But they tend to be markets that will accept more new supply, and so that will tend to even out over the long term.
How's Vegas doing, out of curiosity? Because that one was just crushing it. It seemed a little dangerous. It seemed like one of those markets where it's like, wow, is it real, or is it one of those things that's just kind of go back to Vegas.
yeah, exactly. Right. And kind of thinking, before, kind of it goes back to your comment earlier about people moving from the coast to getting in their car and driving to the Riverside and then Las Vegas and Phoenix. And so it was benefiting from a real out migration from expensive coastal California.
Sure.
That said, just the nature of this pandemic crushing leisure and hospitality and the conference circuit, that the job losses in Las Vegas, I think, through April into May, led the nation. We've seen some a bit of a bounce back there, but really the question is, how fast does the conference, a circuit come back? How fast are people willing to travel to casinos? I know they have already, but I think that pre-corona, the growth was real, and absolutely. Now it's a little bit different, market in terms of, the cost, and you don't want to go in there. And if you're a developer, you don't, want to build a high rise there. And so your strategy is a little bit, different, but so far it's held up relatively well, all things considered, but still a lot of weakness that is materializing in Vegas.
Interesting stuff. Well, listen, I don't want to keep you all day long, Ryan, but it's been great talking to you. Where can we learn more about your work?
Sure. Probably the easiest is wittenadvisors.com. You can go there. All our contact information is there. Feel free to reach out with a phone call or send me an email anytime, and I'll be happy to give you more details on the services that we provide and how we add value to many clients that are in either owner-operators, developers, equity, or lender clients.
Fantastic. Thanks again, and we'd love to have you again, in a few months to reassess where we are at.
All right. Sounds good. Looking forward to it.
We'll be right back. Welcome back to the show, everyone. I hope you enjoyed it. Just remember, we have to just keep asking questions, right? That's the thing. We just don't want to be ignorant. We don't want to be ignorant, right? We don't want to be ignorant. We want to keep asking questions and then thinking about all the possible outcomes that we could have, right? It's like peripheral vision. Right? Understand what's in front of you, yes, but also be aware of potential icebergs, opportunities, missed opportunities. Those are some of the things that you got to be thinking about right now, too. Some of the things that you might not be focused on. Also remember something that I think is important, at least I think it's important, that one way or another, this pandemic is going to end. The recession will end when that happens. And more than likely, we're going to see significant growth. Now, okay, so for obvious reasons, cyclically, after you have a recession, you've got, expansion. But I want you to just for a moment think about what that's going to be like when this thing is over. Just think of the demand, the crazy demand of people wanting to live their lives again. Think about all the places you want to go, all the money you want to spend, right? People you want to visit, places you want to go, concerts, all that stuff. Money will be spent. The economy will grow. That's my opinion, but I truly believe that when this thing ends, it's going to be just crazy how much people are going to be partying like it's, the roaring 20s following the Spanish flu all over again. Anyway, nice to kind of think about that, right? So think about that. It's a positive thing to think about, and I will join you next week for another episode of Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.